Everybody imagine this. Consumer prices climbing back to the highest level of the year. But jobless claims are hitting their highest levels we haven't seen since back in 2021, yet Wall Street rallies to finish off solidly higher somehow. It sounds like a contradiction, right? But this is exactly what makes financial markets and economic news so fascinating, and that is why I'm a nerd about it, and hopefully you are too if you're watching these type of videos. But sometimes they don't react to today's headline, but what to expect in what's coming tomorrow. Now, everything's pointing to next week's huge catalyst, which is the Federal Reserve's interest rate decision. And today and tomorrow, we got to get ready for that. So sit tight, buckle in. Let's start with today's CPI, which was the big data drop of the day. So today we got the August Consumer Price Index, and what we've seen is headline CPI rose to 2.9% year over year, climbing from July's 2.7%. So the trend is up, and it's marking the highest level since January. And on a monthly basis, consumer prices jumped 0.4%. That's double the pace we saw back in July. Now, breaking this down, we've seen shelter costs rise 0.4%, continuing to be the biggest, largest driver of inflation single-handedly. Shelter alone makes up about a third of the CPI basket, so even small moves in this category right here carry a huge weight on the entire basket. Then food prices, normally this is stripped out when you look at the core CPI because it's more volatile and they want to strip out volatile segments like food and energy costs. But food prices were up 0.5% for the month, with groceries climbing 0.6% and dining out rising 0.3%. Year over year, we've seen food costs are now up 3.2%. And even though they strict these out from core CPI, what do we have to spend money on to get to work and to continue surviving? Food costs and energy costs, which energy rose 0.7%, led by a 1.9% spike in gasoline, though overall energy is only up 0.2% compared with last year. So even though we've seen a huge jump in this report, it's not completely terrible. But under the hood, there were some eye-popping category moves. Sewing machines, for example, and fabric supplies jumped 9.1% in just one single month. Maybe people are trying to make their clothing articles here so it's a little bit cheaper. You avoid some of those tariff costs from like Shein and Amazon, a lot of those companies that ship in from overseas. Jewelry prices rose 6.8%, airfares spiked 5.9%, motor vehicle repairs climbed 5% because who can afford a new car right now? So you're going to fix what you got, and mechanics aren't unaware of that. Coffee prices already a sore spot for consumers, that rose 3.6% in August alone, leaving them more than 20% higher than a year ago. And I drink about a gallon of coffee a day. By the end of the day, I'm over here like shaking after work. Now, when we strip out food and energy, the so-called core CPI we were just talking about, prices rose 0.3% month over month and 3.1% year over year. And that's pretty steady from July. And it tells us that while tariffs and supply chain costs are feeding through slowly, inflation isn't spiraling out of control. So what this means is, on one hand, inflation is hot enough to remind us the problem isn't solved yet, the job's not over. But on the other hand, it's right in line with expectations, which means the Fed won't see this as a reason to back away from rate cuts next week. Whoa, 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 whoa. It's not too hot. So this is how it gets pretty interesting. So despite the CPI showing inflation reaccelerating, a lot of people were expecting this to happen, stocks rallied hard today. The Dow jumped 1.36%, the S&P rose 0.85%, the Nasdaq gained 0.72%. Bitcoin rocket shipped up, climbing 1.46%, sitting at around 116,000 right now. And essentially, investors shrugged at the inflation data because the futures markets are laser focused on the September 17th decision, which, according to the CME Fed Watch tool, traders are still pricing in this 25 basis point rate cut as the overwhelming scenario is passing by. The CPI didn't really change the markets, what markets are betting so far. So the Fed is far more concerned about a slowing labor market than about a modest pickup in inflation. So I didn't pull this up. I don't want to take too much time to type it in and everything. Y'all know where to find it. CME Fed Watch tool. Right now at 7:49 p.m. Central Standard Time, 9/11. Right now, it's a 92% chance of a 25 basis point rate cut, and then the other odds fall in that 50 basis point cut, and it seems very unlikely that we're going to get that. But that conviction has been building since last week's weak jobs report. So on Friday, we saw over 5 million options contracts tied to the S&P 500 trade hands, which was the second highest day on record. Much of that activity leaned bullish, and investors were scooping up these call options tied to smaller and more economically sensitive companies. It's a classic case of buy the rumor around the Fed easing, and there's the twist. Historically, markets don't always rally after a Fed cut, so sell the news event. So sometimes the cut signals that the economy is weaker than expected and stocks stumble afterward, and that's why some traders are whispering about this potential sell the news event next week. So buy the rumor, sell the news on the Fed event. Who knows if that's going to happen or not, but that's what a lot of people are saying, that it wouldn't be a shocker if stocks sell off after the Fed decides to cut rates. Then at the same time, we got jobless claims out today. And what those revealed is that there are cracks in the labor markets, and they're becoming harder to ignore. You could try to sweep it under the rug to a certain extent, but initial jobless claims jumped to 263,000 last week, which was the highest level since October 2021, which is a super sharp rise up from that 236,000 figure from the prior week. And these just move in weekly increments is when we get these data. So it's every Thursday we get the week prior's numbers. So that was quite the jump from just a week ago. Now, while most of the spike was tied to flooding out in Texas, the bigger picture shows a labor market that is gradually cooling, and especially cooling when you tie that into the jobs reports that we got last week. Now, continuing claims, which track the total number of people receiving unemployment benefits, held steady at 1.94 million, but the key here lies that the pace of job creation has slowed sharply this summer, and workers are taking a lot longer to find jobs. Younger job seekers are struggling to really break in the door and get a job, especially these recent college graduates who still got these loans they need to pay off for all of those years of school. And we're not even talking about layoffs, while not surging, are no longer rare. So economists are increasingly concerned that we're at this inflection point. The labor market that cools too quickly could shift from this narrative from soft landing to something far more painful. So where this leaves us is that inflation is creeping higher. We can't ignore the signs of that, but we can't ignore the signs of jobless claims are also creeping higher, and yet stocks are creeping higher too. A lot of creeping going on. And that triangle of tension sets up one of the most important Fed meetings in years. The CPI told us businesses are still passing costs on to consumers, but not in a way that derails the Fed's plans, causing meaningful inflation or higher than expected inflation. The jobs claims data told us the labor market is weakening and giving the Fed more reason to react to a weakening labor market. And the stock market told us that investors are betting they're all in agreement that cuts are coming, and we don't know if that's a good thing or a bad thing yet. But the real question isn't whether the Fed cuts next week. It's how markets will react afterwards. Will it be a relief that the Fed is finally stepping in and continuing to cut again? Or is it a concern that the Fed is cutting because the slowdown is already here and something more alarming is behind the curtains. So that's what makes CPI and the coming weeks so critical, y'all. Stay tuned because this story is only getting started, and I'll be sure to cover it and show up daily for y'all so we could keep on learning together. Hope your day's awesome. Enjoy the weekend. My birthday's Friday, so I'll be a little bit older here pretty soon. Y'all have a good